Hello, everyone. I hope you are all doing well. For this lesson, we are reviewing the Chapter 9 PowerPoint on accounting for receivables. This is our accounts receivable and notes receivable chapter. Remember, our receivable is when we are owed money. As a reminder, make sure to have the classwork 9 downloaded so that you can fill it in as we do the PowerPoint. The topics we are covering for the accounts receivable chapter are the direct write-off method, the allowance method, notes receivable, and factoring. When someone owes us money, a risk we may face is that they might not pay us. We don't have this issue if we do business on a cash-only basis. However, many companies extend credit to its customers. I know some business owners who won't purchase from a supplier unless they are granted credit. Even if a company has a strict credit policy, they still run the risk of having defaults. We refer to the uncollectible amounts or the default amount as bad debts. We will write off these amounts using the expense account called bad debt expenses. There are two methods we will be going over: the direct write-off method and the allowance method. Even though we're going over both methods, the emphasis is on the allowance method. The direct write-off method is used mostly for small businesses, while the allowance method must be used for public companies. We will begin by covering the direct write-off method. The reason the direct write-off method is used for small businesses and not the public companies is because there is no matching. This means we are expensing the bad debts in a time period that is different from when we reported the revenue. I will use an example to illustrate this. Let's assume in 2019, we made a $10,000 sale. Our net income would then increase by $10,000. Then let's say we have a 12/31 year end, so in the end of December, we're starting a new accounting period. In 2020, our customer comes in and they default. They say they can't pay that $10,000. Therefore, we'll expense the $10,000 here in this year. Our net income then decreases by $10,000. The issue is that the expense is not matched into the same time period the revenue was made. Our net income for 2019 is $10,000 too high, and our net income for 2020 is $10,000 too low. This is called the matching principle. Expenses should be matched in the same time period as the revenue. And unfortunately, this happens with the direct write-off method. The allowance method won't do this, and we will go over that in a little bit. Because the matching principle is not followed here, this is not considered to be GAAP, the generally accepted accounting principles. This is why only the small businesses can use this method. The public companies cannot because they must follow GAAP. I will now show you how to do the journal entries for writing off accounts using the direct write-off method. First is writing off the account. This is when the customer comes in and says, "Hey, I can't pay you." We will expense this amount using bad debt expense, and we will get rid of their account by crediting accounts receivable to show that they no longer owe us money. In reality, they do. They will always owe us money, but if they're not going to pay us, then we do need to remove them from our books. Otherwise, we would be overstating assets. We would show accounts receivable on there for customers that would never pay us, making it an overinflated number. We might send their account to a credit agency and report them and not do business with them anymore. But for accounting, we do need to take them off our books if they're not going to pay us. So this journal entry expenses the amount that we previously recorded as income because we're not going to get that income, and it gets rid of their account on our books. Now, let's say later on the customer comes back and says, "Hey, I can pay you." This is called a recovery. We're recovering the bad debt. This does happen, maybe not that often. A lot of times when we do write customers off, they're gone for good. At the accounting firm, we've written off many customers. We did their tax returns and they never paid us. So we did write them off, and then maybe a couple years later, they want their taxes done and they're willing to pay us for the old debt that they owed us. Doing a recovery is a two-step process. First, we have to reverse the write-off. That's where this first entry comes into play. It's the opposite of the write-off. We're putting the client back on our books and we're reversing the expense, the write-off that we did. The second step is to just collect the money like you normally would. A journal entry you've done so many times already. We're going to receive the cash and we're going to take the customer off our books because now they're paying us. We first have to put them back on our books and then we take them back off again. We'll now do an example together. This is your practice problem number 1 on your classwork. We have Dexter Company that applies the direct write-off method and accounting for the uncollectible accounts. Prepare the journal entries to record the selected transactions of Dexter. On March 11th, Dexter determines that it cannot collect $45,000 of its accounts receivable from its customer, Lear Company. This happens on March 11th. This is the first entry that we showed on the previous slide. This is when we're writing off the client. They're deadbeats. They are defaulting on their account. We expense this amount and we get rid of their receivables so they are no longer on our books. And we'll do it for the amount that we are not collecting. We debit bad debt expense for the amount of their bad debt. And then we credit accounts receivable. And please get into the habit of writing out the name of the client since we're going to have many businesses we're dealing with, and we're going to assume that we're using subsidiary ledgers. We'll write off their account for the $45,000. This is usually it. We finish here. However, in this case, on March 29th, Lear Company unexpectedly pays its account in full to Dexter Company. Dexter records its recovery of this bad debt. So now this client has come in who we previously wrote off and they say, hey, I can pay you. Maybe they made a big sale or their business is doing better and they can come back and pay us. We need to reverse what we just did on March 11th by flipping it, reversing it. Instead of crediting accounts receivable, we're going to debit it for $45,000. Instead of having a debit for bad debt expense, we'll have a credit for bad debt expense for the same amount. Then, as you normally would, just collect a receivable. We would be receiving the cash of $45,000 and we would write off their account of $45,000. Please don't get confused on this last entry. We've been doing this since chapter 2, collecting money when somebody owed us money. Next, we'll cover the allowance method. With the allowance method, we are not going to run into the same issue of violating the matching principle as we did with the direct write-off method. This is because at the end of each accounting period, we're going to expense bad debt expense by doing an estimate of uncollectible accounts. Instead of waiting for a customer to default, then writing them off, which could be in a different fiscal year, we will write them off. Now it's going to be an estimated amount, but it'll be in the same year as the sale. The advantages are that the expense and the sales will be recorded in the same time period, and the amount of accounts receivable on our balance sheet will be more up to date with the amount we actually expect to collect. Next, we'll be covering the journal entries for the allowance method. First, we're going to go over the estimate of the allowance. This is done at the end of the accounting year. No one has defaulted. We're just going to assume that some people will. After we're done practicing with these journal entries, I'll show you how to calculate this amount because we can do it a few ways. But for right now, we're just going to go over the journal entry portion. To estimate the allowance, we're still going to use bad debt expense because we are still writing off accounts. Instead of writing off specific accounts, we're going to credit allowance for doubtful accounts. Allowance for doubtful accounts is a contra accounts receivable account. This is the amount that we're going to estimate is going to be uncollectible. I'll explain how this looks on the balance sheet. Let's assume this is the beginning of our balance sheet. We have cash at 10,000, supplies at 2,000, accounts receivable of 8,000. The allowance for doubtful accounts is a contra accounts receivable account, meaning that it is linked with the accounts receivable account, but it does the opposite. It brings it down. The allowance for doubtful accounts will subtract from this number. Let's say we're going to estimate that $1,000 will be uncollectible. We will subtract it from here, which means our net accounts receivable, the amount we actually think we're going to collect, would be $7,000. This is all linked together, this part right here. It's 8,000 minus 1,000. We're only going to show the 7,000 on our balance sheet. This is a more updated number. We're not overinflating our accounts receivable. We think we're going to collect $7,000 worth of accounts receivable, not 8. We're being a lot more conservative by using this approach. Now, $1,000 doesn't seem like a lot, but some companies have millions and millions of dollars of accounts receivable on their books, and millions of dollars can be defaulted on. It makes a big difference showing the real amount you actually think you're going to collect versus showing the total amount. Once again, the journal entry is a debit to bad debt expense and a credit to allowance for doubtful accounts. This amount here would be the estimate. At this point, no one has come into default. It's just the end of the year. We want to update our accounts receivable to show the amount we actually think we're going to collect and write off our expenses in that same time period we have the sales. Now, let's say it's the next year and someone does come in and they default. We had a feeling that was going to happen. We already estimated it, but now it's official. Someone's writing off their accounts. Instead of debiting bad debt expense like we did with the direct write-off method, we already did that here. And we put the amount we think will be uncollectible in allowance for doubtful accounts. So we're going to take it out of the allowance for doubtful accounts because we thought a certain amount of people would default. Some people did. Now we think it's going to be a lesser amount. We're going to debit allowance for doubtful accounts and then credit the accounts receivable of the customer who defaulted. It's very similar to the direct write-off method where we did the debit to bad debt expense and the credit to accounts receivable. We just have this middle step here where we use allowance for doubtful accounts as like a temporary holding account. We're going to credit it here and debit it here so it does cancel out and we're left with the same result. Just like with the direct write-off method, we went over what happens when we write someone off and later on we can recover them. Same thing here. When we recover it, we're going to reverse the write-off. We did a debit to allowance for doubtful accounts, so we'll credit it. We did a credit to AR, we're going to debit it. Same thing with the direct write-off method. When we recover it, we'll reverse the write-off and then collect the cash as you normally would. We'll get the cash and then we're going to write off their account because they did pay us. Let's do a practice problem with this. This is number 2 on your classwork. We have Gomez Corp uses the allowance method to account for uncollectibles. On January 31st, it wrote off an $800 account of a customer C Green. On March 9th, it receives a $300 payment from Green. Prepare the journal entry or entries for January 31st and March 9th. Now this problem is a little different. I'm going to go backwards for a moment. We're assuming this part right here, the estimate of the allowance, was already done in the end of December. What we're going to be doing now is writing off the account and then recovering it. These last 2 entries right here. We are going to practice doing the estimate in a little bit. On January 31st, we need to write off the $800 account from C Green. Remember to write off the account. It would be allowance for doubtful accounts, the amount that we're writing off, and then the customer's name, accounts receivable C Green in this case for $800. Then on March 9th, They can actually pay us 300. It's not the whole thing, but they can pay us a portion of their bill. This is March 9th. We're going to have to reverse this entry we just made to write them off. It's the opposite. The debit becomes the credit and the credit becomes the debit. Then collect the money as you normally would, just like with the direct write-off method. We're getting the cash and it covers the accounts receivable of C Green. Like I said before, this problem here skips the 1231 estimate, but we're going to be going over that part now. To estimate the bad debt expense at the end of the accounting period, there are two methods. One is the percent of sales method. This is the easier one. The second method is the accounts receivable method, and there are two ways to do this. We can do the percent of accounts receivable or use what's called an aging schedule, aging of accounts receivable. We're going to be going over all of this now. Remember, this is the estimate of the bad debts at the end of the year. We're going to start by going over the percent of sales method first. This is when management estimates what percentage of credit sales will be uncollectible. We're doing this based on the amount of sales we made. For example, we believe that 10% of all of our sales will be uncollectible. Management will use past information to come up with this percent. They will use their credit policy, depending on how strict they are with loaning out credit to its customers, and the past experience with it. It's very easy to calculate this amount. It would just be the amount of sales times the bad debt percent. If we had $100,000 in sales, and I think that 10% will be uncollectible, that would be $10,000. All you do is multiply the percent by the sales, and that would be the amount of the estimate. That would be the amount we journalize. It's very easy to do this one. We'll do a practice one. This is number 3 on your classwork. We have Warner Company's year-end unadjusted trial balance, which shows accounts receivable of $99,000, allowance for doubtful accounts of a $600 credit, and sales of $280,000. Uncollectibles are estimated to be 0.5% of sales. Prepare the December 31st year-end adjusting entry for uncollectibles. We definitely have more information than we need here. All we really need is the amount of sales and the percentage. As a reminder, the journal entry for estimating the allowance was a debit to bad debts expense and a credit to allowance for doubtful accounts. We just need to come up with the amount in this case. The date is 12/31, and like I said, the journal entry would be a debit to bad debt expense and a credit to allowance for doubtful accounts. Now let's see if we can determine the amount. Remember, the amount would be the percent of the amount of sales. Sales is $280,000, and we think that 0.5% will be uncollectible. We would multiply the 280,000 times 0.5% or 0.005. This will equal 1,400. Make sure you do the math as well so that you're able to do the percent correctly. This would be the journal entry at the end of the year. This is us estimating the bad debt expense. In this example, no one has defaulted yet. We're just going to assume that $1,400 worth of our sales will be defaulted on. We're going to expense it in the same time period we made the sale, and we're going to offset our accounts receivable by $1,400. Right now, our accounts receivable shows that we have $99,000. So on the balance sheet, we'll actually take off $1,400 of that to show the net accounts receivable, how much we actually think we'll collect. Next, we'll go over the percent of receivables method. The percent of the receivables method can be done in two ways. We can use the percent of accounts receivable or an aging schedule, aging of accounts receivable. There are two steps in order to calculate the amount for the journal entry. The first one is to do an estimate of the allowance using one of these two methods. The percent of receivables would just be the same thing as percent of sales, but we'll be taking a percent of the accounts receivable account as a whole. We'll be going over the aging of accounts receivable as well coming up in a few slides. First, we'll just start really with the percent of accounts receivable because it's easier. You still follow the same steps when you get the estimate though. Use one of these methods to get the estimate of the allowance. Now, normally with the percent of the sales, we would just do the percent, that's us estimating the allowance, and then journalizing that number. We have a second step here. We have to look at the balance in the allowance for doubtful accounts account. This can be a little tricky, and I'll try my best to explain why this is. Let's just use the percent of sales method first. In 2019, we had sales of 100,000, and 2020 sales of 150,000. Let's say it's 10% that we believe is uncollectible. We'll do 10% of the 100,000 in one year and 10% of the 150,000 in the next year. These numbers are completely independent of one another. My sales of 100,000 in 2019 are not included in my sales of 2020. We're not duplicating any information when we do 10% of both these numbers. Doing 10% of this 150,000 would have nothing to do with this 100,000 here. Now let's look at the percent of accounts receivable method. In 2019, we had accounts receivable of 20,000, and in 2020, we had accounts receivable of 15,000. If we just did, let's say, 10% of each of these numbers, that would be the percent of accounts receivable for that year. However, the issue is some of this 20,000 might be included in this 15,000 here. If there's a client that owed us money in 2019, it could have carried over to 2020. Now, ideally, hopefully we'd write off these clients who have owed us money for more than a year. Let's say John Smith owed us $1,000 in 2019 and never paid us. Now it's 2020, his $1,000 that he owes us is still included in this number right here. If we did 10% of 2019 and 10% of 2020 to write off, we would be duplicating an amount. We'd be doing 10% of this one client's account, and we would be doing it again in the next year. I know this sounds a little confusing, and I'm just explaining why. If you don't really understand what I'm talking about, that's okay. Just kind of memorize the steps that we're doing. But basically, we have to look at the allowance account because we don't want to have duplicate information in there. Percent of sales, we don't have to worry about that because it's all new information, but percent of accounts receivable can carry over year after year after year, and we won't be writing off the same information over and over and over again. Therefore, when we do this method, we'll have to do the estimate of the allowance. We'll use a percent of the accounts receivable, or we'll do the aging schedule. Well, that's coming up next. And then we'll have to subtract that from the previous balance in the allowance for doubtful accounts to come up with the bad debt expense, the amount we journalize. Here's a little tip. If the balance in the allowance for doubtful accounts had a credit balance, we're going to subtract. If it had a debit balance, we're going to add the numbers together. I'll explain what this means next when we do an example because I think it might make a little bit more sense. This is problem number 4 on your classwork. We have Maisie Supply Co. who uses the percent of accounts receivable method to estimate bad debts. On December 31st, 2017, it has outstanding accounts receivable of $55,000 and it estimates that 2% will be uncollectible. Prepare the adjusting entry to record bad debts expense for the year 2017, under the assumption that the allowance for doubtful accounts has, and in Part A, it's a $415 credit balance before the adjustment. As a reminder, regardless of what method we're using, estimating the allowance is always this journal entry right here, bad debt expense and allowance for doubtful accounts. We're just trying to come up with the amount here. So first I'm just going to put these 2 account names in, and then we'll figure out the amount. The date is 12/31. It's the end of the year. We have a two journal entries, bad debt expense and allowance for doubtful accounts. Remember, always use these when we're estimating the allowance. Now, to come up with the amount, it's the percent of receivables. We start off the same way we did percent of sales, but we'll use percent of receivables. It's the percent we think will be uncollectible times the amount in the account. In this case, it would be the accounts receivable account. We're going to do 2% of 55,000. 55,000 times 2% equals 1,100. If this had been the percent of sales method, we would just take this amount and put that as our amount for the journal entry. However, because we're using percent of receivables method, we do have to look in the balance of the allowance for doubtful account. In this case, it was a $415 credit balance. Shown in the previous slide, if there was a credit balance, we're going to subtract the two numbers and then journalize that amount. We'll take the 1,100 minus 415. Like I said, because it's a credit balance, we're subtracting. And I'll explain why in a moment. When we subtract these two numbers, we get $685, and this is what we'll journalize. Subtract these and journalize that amount. Now for part B, it's the same exact scenario, except there's a $291 debit in the allowance for doubtful accounts account before this. The first part still stays the same. We still do 55,000 times 2%, which equals 1,100. We will then have to look at this balance to see what the amount is that we journalize. The accounts are still the same. It is still 1231, still a debit to bad debt expense, and still a credit for allowance for doubtful accounts. The only thing that's going to be different is the amount. We're going to take the 1,100, and because there is a debit balance in this case, we're going to add the two numbers together. 1,100 plus 291, we get 1,391. When we did 55,000 times 2% and we got 1,100, this is the amount that we want in the allowance for doubtful accounts as the balance. Because allowance for doubtful accounts is a contra receivable account, it has a credit balance. I drew T accounts to help illustrate this from part A and part B. This is the allowance for doubtful account, T account. We want 1,100 as our balance on the credit side because this has a credit balance. In the case of part A, there was already a $415 credit balance in that account. We have $415 in there, but we want 1,100. Therefore, we subtract these numbers to see what we need to add to the account. In part A, we added $685. 415 plus 685 equals 1,100. Now the balance has what we want, and we had to do this $685 credit to the allowance for doubtful accounts. In part B, there was a $291 debit balance, basically showing it's negative, meaning that more people wrote off accounts than what we had estimated. We want an $1,100 credit balance, but we're currently negative $291. That's why I said we need to add these numbers together. We need to cover the $291 we're negative, plus an additional $1,100 to bring the account to $1,100. That's why in part B, we had to do a credit of $1,391. A debit of $291 and a credit of $1,391. Opposite sides you subtract, we get 1,100. We want the balance to be 1,100. Even if you don't really understand everything I'm talking about once again, as long as you remember what to do. If there's a credit balance, you subtract your estimate from that balance. If there's a debit balance, you add it to the estimate you got, and then you would journalize that number. The last method we're going to learn is the aging of receivables method. Remember, the aging of receivables method is still done the same way of the percent of receivables method. The only difference is we're not just going to take a flat rate, like a flat percent with all of the receivables. We're going to divide the receivables into different categories. We're going to classify each receivable by how long it's past due. We're under the assumption that the longer something is past due, the more likely we're not going to collect it. If someone is only maybe a month late of paying me, I can still assume that I might get that money. If someone is 6 months late in paying me, I can probably assume that I'm not going to get that. We're going to have different percentages based on how long an account is past due. The longer it's past due, the percent of it being uncollectible will increase. That's why this method is different than percent of receivables. Percent of receivables takes a whole chunk and just multiplies it by 1%. We're going to take those who aren't that late and multiply that by percent, and then those who are really late, multiply that by a different percent. Let's do a practice problem because I think it might be easier to show you how it's done by practicing this. This is number 5 on your classwork. We have daily company who estimates uncollectible accounts using the allowance method at December 31st. And prepare the following aging of receivables analysis. And in this chart here, it shows that the total amount of accounts receivable is 570,000. Under the percent of receivables method, we would just take 1% and multiply it by this 570. Instead, we're going to classify the accounts by how past due they are. For instance, this first column is those who aren't past due at all. We think maybe 1% will be bad debts, will be uncollectible. Those who are 1 day to 30 days late, we increase that a little bit, 2%, and so on, 5%, 7%. And those who are over 3 months late, we say maybe 10% will be uncollectible. We increase this the longer an account is overdue. So instead of taking 1% to the whole amount, we'll do it into categories. So for part A, you have to complete this table here to calculate the estimated balance of the allowance for doubtful accounts using the aging of receivables method. We're basically just copying the information from this first chart into this second chart and then multiplying the amount of the accounts receivable by the percent. So those not due yet, this first box would be the 0, the 396. Those are 0 days late. And the percent would be 1%. All this is done for you already. Then you would just have to calculate this amount. And please, everyone, actually do this in your calculator because I see so many students not being able to multiply percents correctly. So make sure you can do this and you're following along so you don't get it wrong on the test. 1% would be 0.01 in the calculator. When you multiply this, you get 3,960. We would do the same thing for the next line, 1 to 30 days. We look at this, 1 to 30 days, 90,000 and 2%. 90,000 times 2%, we get 1,800. Do it for the remaining columns. 36,000 at 5% is 1,800 as well. 18,000 at 7% is 1,260, and 30,000 at 10% is 3,000. What we do now is add all the amounts up to give us $11,820. As a reminder, when we're using any of the receivables method, whether it's the aging of receivables or percent of receivables, we're not just going to journalize this $11,820. We need to look at what the balance is in the allowance for doubtful accounts. And that's what we're going to do here in Part B. Part B is to prepare the adjusting entry to record the bad debt expense using the estimate from Part A. Assume the unadjusted balance in the allowance for doubtful accounts is a $3,600 credit. As a reminder, $11,820 is the amount we calculate from the aging schedule. When we journalize the estimate, it's always the same. We've done this several times already. 1231 is going to be bad debt expense and the allowance for doubtful accounts. Just memorize this because we're doing this every single time. The harder part is coming up with the amount. Remember, we're not just journalizing the 11,820. We need to look at the balance in the account, which is a $3,600 credit. Remember, when there's a credit balance, we subtract. We'll take 11,820 minus the 3,600. The amount we get is 8,220. That's the amount we journalize. Part B, same situation, except the balance in allowance for doubtful accounts is a $100 debit. Once again, before we even calculate the amount, we can put in the journal entries because it's exactly the same. I do have a lot of students who always reverse this for some reason. It's exactly the same every time, regardless if it's percent of sales, percent of receivables, or aging of receivables. Doing the estimate is always the same journal entry. Now, to come up with the amount, because it's a debit, we add. We'll take the $11,820 plus $100. When we add these numbers, we get 11,920, and that's our journal entry. I have the notes page out to show you a summary of this. We have the percent of sales, which is just the percent times the sales. Or we could do the percent of receivables, which is just a percent of the receivables, or we can use an aging schedule. You'll need to add or subtract it from the allowance from doubtful accounts balance. If there is a credit balance, you subtract, a debit balance, and you add. This is to estimate the allowance. This right here, bad debt expense and allowance for doubtful accounts. The amount you do the estimate for would either be percent of sales or percent of receivables. Everything else would be the same. Now we're going to move on to our next topic, which is notes receivable. Notes receivable is very similar to accounts receivable. Instead of one of our clients or customers owing us money, this is when we have a promissory note, which is a written promise to pay a specified amount of money, usually with interest, either on demand or a stated future date. This means that we kind of like loaned money to someone. Instead of making a sale and saying, okay, pay us later, we're doing like a straight loan. And they do have to sign this note stating that they're going to pay us back. It's a little different because it also has interest. This is an example of what a promissory note looks like. Kind of looks like a check. These can actually be really lengthy contracts. This is just a very simplified version of what would be discussed on it. It would be the amount that the person is borrowing that they owe us, the date, how many days they have to pay and who do they have to pay, and the amount of interest. And then, of course, the parties should sign this as well. Now I'll show you how to compute the amount of interest, because that's really the calculations that happen here. If I loan someone $1,000, they're going to have to pay me back the $1,000 plus the interest. That's the part we really have to focus on calculating. Some key terms here first. The maturity date is the date that they have to pay us back. They have to pay us back the full amount of the note plus the interest. We call this the maturity date. It could also be the due date. To calculate the interest, we'll take the principal of the note of the loan. That's how much you lent out. The principal is the full amount. If I gave someone $1,000, that's the principal amount. You're going to multiply that by the interest rate times the time expressed in fraction of a year. Whenever you have interest rates in terms of finance, it's always for a whole year. If I loan someone $1,000 and say there's 5% interest, and I say they have to pay me back in a month, it's not 5% interest over the next month. It's 5% for the year, and they would only give me 1 month's worth. This is also how your credit cards work, your car loans, all that type of stuff that you have. The interest rate is not on a monthly or daily basis, but it's on a yearly basis. You might get charged interest every month, but it's only a fraction of it. A lot of your credit cards might be at the 20-something% range. If you look at what you're actually charged in interest, you're not being charged 20% of your bill every single month as interest. That would be outrageous, and you would never be able to pay it back. It would be that 20% for the whole year. This is really good to understand how this works now when you're at the point in your life that you might actually start getting credit cards and taking out loans. We're going by the banker's rule here, assuming that there's 360 days in the year, which is 30 days every month. For example, if I loaned the $1,000 loan to someone with 5% interest, I would do $1,000 times 5% interest. And then I would figure out how many months it is for them to owe me the money. Let's say they owe me the money in 3 months. It would only be 3 out of 12 months they'll need to pay me the interest for, not for the full year, not the full 5%, just 3 out of the 12 months in the year. We'll do some examples to go over this though. Next, we'll be discussing how to do the journal entries for this. For the initial sale, instead of it being accounts receivable on our books, it'll be notes receivable, implying that there's interest involved. The credit would either be sales revenue or cash, depending on the situation. If you're just loaning someone money, it would be cash. If you sold them something and they're going to pay you later, it would be sales revenue. Most of the time, it would be accounts receivable and then sales revenue. This would be if we're kind of like sticklers saying, hey, yeah, you can pay us later, but you're going to have to pay us interest if we're extending you this credit. Maybe it's a new customer, you don't really trust them so much, so you're trying to mitigate your risk a little bit. But in this case, there would be interest involved and someone does owe us money. At the end of the time period, we'll have to record the honored note, meaning that they're going to pay us the amount they owe, plus they're going to pay us for the interest. Note that this textbook does go over dishonored notes when someone does not pay us, but we're not going to get too technical with that. All I want you to know is the initial sale of the note and then getting paid from the note. Now, this is a journal entry when they do pay us in the same accounting period. The next slide will go over when the note spans over multiple accounting periods. But here at the end of the term, we're going to get the money back from the note, however much they owed us. In my example, it's been $1,000 plus the interest, whatever the interest is that they owe us. That will be the amount of cash we're going to receive. Remember, debits have to equal credits, so the note plus the interest will be the amount of cash I'm receiving. Once again, this is if it's in the same accounting period. For instance, it's 2020, I lend you the money in 2020, and then you pay me back in the same accounting period. It doesn't go into next year. We'll discuss that next. Let me show you an example of why we're doing what we're doing next. If I lent you money sometime in 2020, and think of this as a timeline, this is the end of the year, and then we get into 2021. If I loaned you money sometime here in 2020, and you paid me back in 2020, we would calculate the interest for this time period. I would get the money back along with the interest. That's the journal entry I had just showed you. Now let's look at it if it expands more than one accounting period. Let's say I loaned you money in 2020, but you're going to pay me sometime in 2021. You're going to pay me the initial amount of the loan plus all of this interest in this time period. However, we end our year here, the end of December. We have to show that we actually earned interest in 2020. Then in 2021, we have to show that we're earning the rest of the interest, and then we're going to get paid the full amount. We have to do one journal entry here at the end of the year to say, hey, even though I have not received the interest yet, I'm going to, but I earned it in 2020. Then we do another journal entry when the note is honored, when we receive the money saying, hey, we got all the money from this time period and all the interest from this time period as well. The first journal entry at the end of the year will look like this. We'll have interest receivable. It's the amount of interest we earned in that year that they owe us for, and they're going to pay us the next year. And interest revenue as the credit to show that I have earned money last year. In this current year in 2020, even though I'm not going to get paid for it until next year, it's still revenue in this year. The next journal entry would be recording us receiving the money. we will get the full amount of the note back plus the interest receivable, the amount that we earned the year before. That number will go here. Plus interest revenue would be the amount this year. So for my example, the interest receivable would be the amount we earned in 2020. Interest revenue would be the amount we earned in 2021. When you add this together, it's the full amount of interest for the full time period. We take the full amount of interest plus the note amount. That's how much I'm receiving in cash. Remember, cash has to equal all of this added together. I know this is a little tricky, but just try to follow along the best you can. We're going to be doing the last practice problem, number 6 on your classwork. Dog Company's December 31st year-end unadjusted trial balance shows a $10,000 balance in notes receivable. This is the principal amount of the loan. The balance is from one 6% note dated December 1st. 6% is the interest for a whole year. Remember that. On December 1st is when we gave out the loan, and is a period of 45 days. That's when they have to pay us. Prepare journal entries for December 31st and for the note's maturity date, assuming it's honored. To visually show you what's going on here, on December 1st, we gave out the note, and then 45 days later is when they have to pay us. If we gave out the note on December 1st, they would owe us in the middle of January. That's 45 days later. It's a month and a half. Remember, just assuming there are 30 days in a month to make this easier. Our first journal entry will be done on 12/31 to show the amount of interest earned during this time period, from December 1st till December 31st. It's a 1-month time period. How much interest was earned during 2020? Remember, we're not going to get that money until January 15th, but we did earn it in this year. We use the formula where we take the principal amount of the loan, which is $10,000, times the interest rate, which in this case is 6%. That would be the interest for a full year, but we just want 1 month. There are 2 ways to do this. The way the book does it is they do times 1 out of 12 months. The way I do it, it's a little different. We'll start off the same. I divide by the 12 months, and then I would multiply it by the amount of months that the time period's for. In this case, it's 1, so I would just leave it as this. Regardless on how you do it, it does not make a difference. You get the same answer. 10,000 times 6% times 1 out of 12, just for 1 month, would be $50. This means during this time period of December 1st to December 31st, I earned $50 in interest. This is the first journal entry that we need to make, is to show that right there. As a reminder, the entry is interest receivable and interest revenue. The date is 12/31. We'll put the entry in interest receivable, interest revenue, what I just showed you, and the amount that was earned in this year, which was $50, which we just calculated. Now we'll try to figure out what the next entry would be. We have to calculate what the interest would be now in this time period, and then we're going to add it to the last time period plus the principal to figure out our cash amount. From December 31st to January 15th, it's only half a month, 15 days. If $50 was the amount for a full month, then how much interest would we earn for half a month? It would be $25. Therefore, the full amount of interest we're receiving for the whole life of this loan is $75, but 50 of it was earned in 1 year, $25 in the other year. And that's what we're journalizing now. We're going to show that we're receiving the $50 we were owed from last year's interest, plus the $25 from this year's interest, plus the full amount of the loan, which was $10,000, and we're receiving all of that in cash. I'm going to go a little backwards here with doing the journal entries. It's going to be on the 15th of January. That is the maturity date. The amount of the note is the full balance they owed us, which was 10,000. Interest revenue would be the interest from this current year, basically from January 1st to January 15th. This year's amount was $25. Then we're going to add to it the amount from last year. That's the interest receivable here. Whatever amount you have there would go here. We were owed a total of $75 in interest, 50 of it from last year, 25 from this year. How much cash are we getting in total? It would be the sum of all of this together, which is $10,075 in cash. We have one more quick topic to talk about. That's selling receivables, otherwise known as factoring. Think of factoring like a collection agency. Right now, someone owes us money. Instead of waiting around a month, two, maybe more to receive this, if we need it cash now, we can sell this to someone else. That person will then collect from our customers. It's like getting a middleman. Instead of the customer paying me, I will get my money from another company and the customer will pay that company. It's called a factor, and if you Google it, there's tons of factoring companies out there. Now, the factor, the company that is going to buy the receivable from us and then collect from the customer, they will charge a fee. It's called a factoring fee. They do need to get something out of it in the end. This means that when I sell the receivable, let's say someone owed me $1,000 and they charge me a fee, I'm not going to get the full $1,000. I might get $990. Maybe they charge $10 for this. Now that company, the factor, will try to get the full $1,000 from the client. I'm only getting $990. However, it is beneficial because now I'm getting my money now instead of waiting around for it. The fee is a negative, but I get my money quicker. It really depends on the company if this is beneficial or not, if they should do this. This is not a classwork problem, but I did want to show you an example for this. A company sells $10,000 of receivables to a factor who charges 2%. The way I journalize this is I put the full amount of accounts receivable at the bottom because my accounts receivable is going down by 10,000. I'm getting rid of the whole thing. No one owes me money anymore. There is a fee. 2% of $10,000 is $200. How much cash am I actually receiving then? It would be the $10,000 minus the $200 fee. I'll be receiving $9,800. I am selling someone $10,000 worth of receivables. They are paying me $9,800 cash for it. Like I said, that factoring company will then try to collect from my customers. Hopefully they get the full $10,000, but it might take some time for that to happen. At least I get $9,800 today. This is the end of the Chapter 9 PowerPoint. I know it kind of got a little confusing, and I really did try to explain everything. We really didn't understand all the little details. That's okay, it happens. But at least try to understand how you do the journal entries, because that's the part that you'll really need to know. I just like to explain everything, the reasoning behind it. That doesn't mean you have to understand that as well. I don't want to confuse you more, but practice this a little bit. Do the classwork more than once. Make sure to actually read the chapter because the book does go into a lot of detail with this. Once again, you can always reach out to the pals if you need help with this, or send me a message. I hope you all have a great week. Please continue staying safe and healthy.